So, Chapter 15, Long-Term Financing. In this chapter, we examine specific features of both stocks and bonds. We begin with stock, both common and preferred. In discussing common stock features, we focus on shareholder rights and dividend payments. For preferred stock, we explain what the preferred means, and we also debate whether preferred stock is really debt or equity. So first, let's talk about the common stock features. The shareholders have the right to vote for the board of directors and other important issues. The cumulative voting increases the likelihood of minority shareholders getting a seat on the board compared to straight voting. The proxy votes are similar to absentee ballots. Proxy fights occur when minority owners are trying to get enough votes to obtain seats on the board or affect other important issues that are coming up for the vote. Different classes of stock can have different rights. Owners may want to issue a non-voting class of stock if they want to make sure that they maintain control of the firm. Other rights exist, such as to share proportionally in declared dividends or also in remaining assets during liquidation. The preemptive right is the right to purchase new stock issued so as to maintain proportional ownership. So now, let's talk about the features of preferred stock. Preferred stock pays a cash dividend expressed in terms of dollars per share. The features of this are that the stated dividend must be paid before dividends can be paid to common stockholders. Second, dividends are not a liability of the firm, and preferred dividends can be deferred indefinitely. And third, most preferred dividends are cumulative. Any missed preferred dividends have to be paid before common dividends can be paid. A lot of features of preferred stock are similar to debt. In fact, many new issues have sinking funds that effectively convert what was a perpetual security into an equity security with a definite maturity. However, for tax purposes, preferred stock is equity, and dividends are not a tax-deductible expense unless they meet specific characteristics.
Now we move to the corporation long-term debt. The security issued by corporation may be classified really as equity security or debt security. So we need to find the difference between the debt and the equity. With debt, it's not an ownership interest in the firm, and the creditor do not have voting power. Moreover, the corporation payment of interest on debt is considered the cost of doing business and is fully tax deductible. Moreover, the equity is the ownership interest and the common stockholder have the power to vote. The debt security typically called as the notes or bond. So now I will talk about it deeply. So firstly, we will talk about the bond indenture, and this is the contract between the company and the bondholder, and it includes six things: is the basic term of the bond, or the total amount of bond issued. Next is description of the property used and the security if applied. Another thing is sinking fund revisions, call revisions, and detail of protecting convenience. And now we move to the bond classification. So the first thing is the bond need to either register form or bearer form. The corporation bond is usually in register form. In contrast, the bearer form is rarely used because it has some risk. Firstly, it's very difficult to recover if they are stolen or lost. second thing is the company do not know who is the owner of bond. And next is the securities, and there are collateral. Collateral is secured by the financial security. And the mortgage is secured by the real property, normally land or building. And the debenture or notes is unsecured, and these are the information that you can learn in the business law. And the last thing of bond classification is seniority. So after we concern about the bond classification, we will continue with the required use. Bond rates depend on the risk characteristic of the bond when issues, and which bond will be the higher coupon. We will concern about the secured debt and the debentures, and the subordinate debenture with senior debt. The next thing is the bond with the sinking fund versus the one without, and the cable bond versus with the non-cable bond.
So my name is Hannah. Now I will continue with the zero coupon bonds. So this bond had the coupon rate of 0%. So therefore you don't have to pay the interest at the maturities. So the entire YTM of this bond is come from the difference between the purchase price and the face value of the bonds. So this bond cannot sell for more than the face values. Moreover, sometimes this bond has other names like deep discount bond, or the original issue discount bonds. So a good example for this bond is the treasury bill or the treasury skip. So move to the per discount bonds. With this bond you don't have to pay the interest, and you just have to pay back the face value of the bonds. The information to determine the value of this bond is contained of the time to the maturity, the face value, and the discount rate. And the present value of this bond is computed by the formula PV equal face value divide by 1 plus R to the power of t. So we come to the example with about finding the present value for the bond of 30 year zero coupon with a 1000 par value and a YTM of 6. So to calculate the present value, you take 1000 divided by 1.006 to the power of 30, and then you get a result. So with the following race bond, this bond had a coupon rate depend on the index values, and a good example of this is you can see obviously in the inflations, and this bond have less price risk, and moreover the coupon of this bond may have a collar, which means the rate that can go over the specified ceiling, and more cannot go below the specified floor.
Hello, I'm Vấn and I will continue my friend's part to present to you about other bond types. So there are income bonds. This income bond is dependent on the company income, but it's only paid to the bondholders only if the income is sufficient. So this kind of bond look so attractive, but it's not very common. And the second bond types is convertible bonds. It can be exchanged with shares anytime before maturity, but it is relatively common. But the amount of these bonds has been decreasing in recent. And the last bond types is put bond, and it allows the holder to force the issuer to buy back the bond. This feature is just the reverse of the call provision. And there are many other types of provisions that can be added to a bond, and many bonds have several provisions. It is important to recognize how these provisions affect required returns. So we will move to the bank loans. So in the bank loans we have lines of credit. What is line of credit? It provides a maximum amount the bank is willing to lend the borrower. So if guarantee referred to as a revolving line of credit. And what is the advantages? Why we have to use the line of credit? Yes, because the borrowers only charge interest on the funds they draw in this line of credit. And the second one is the interest rate is often lower than the one-time loan, than that of one-time loan. That the loan that you have to loan, that you have to borrow a lot, but you don't use it. So we will continue with syndicated loan. And what is syndicated loan? That's the money. We have less money. The central banks frequently have more demand for loans than they have supply, and not many people demand for that much money. And we have small regional banks often in the opposite situation, that they have less demand for loans than they can supply. So as a result, a larger money central bank may arrange a loan with a firm or country and then sell portions of the loan to a syndicate of other banks. A syndicated loan may be publicly traded. And next is international bonds. We have Euro bonds. It's the bonds not denominated in a particular currency and issued simultaneously in the bond market of several countries. The second one is foreign bonds. It's the bonds issued in another nation's capital market by a foreign borrower. And okay, next we will go to the patterns of financing. The previous section of this chapter discussed some institutional detail related to long-term financing, and now we consider the relationship between long-term financing and investment. As we have seen in the earlier chapters, firms want to spend on capital projects with positive NPV, net present value. And so how can these firms get the cash to fund investment? First, firms get generating positive cash flow internally, can use that flow for positive NPV investment. And the second one is firms can fund positive net present value capital spending through external financing like issuing debt and equity.
Is the long-term financial deficit. So in the figure 15.1, it indicates that this relationship between the investment and the financing. And the left side is the figure indicate that the cash flow can fund both the capital spending and investment in the net working capital. And the right hand side of the figure show the two sources of the cash flow, internal and external. And in the figure, uses of cash flow show is it the internal financing, and moreover, the stock and bond must be issued to fill the financial deficit. We come to recent trends in the capital structure, which are the best book or market values. In general, financial economics refer the market values, and when calculating the debt ratios, also in the chapter 14 indicate that market price reflect the current informations, but however the use of the market values does not mean that the book values should be ignored. And however, the corporate treasurer may find the book values more appealing due to the volatilities of the stock market. It is frequently claimed that the inherent volatilities of the stock market makes the market-based debt ratios move around too much, and moreover, the restrictions of the debt in the bond covenant are usually expressed in the book values rather than the market values. And whether we use the book or market values, the debt ratios for the US non-financial firm generally have been well below about 100% of total equities in the recent years. And that is why the firm generally use less debt than equity.